How small apartment investors can evaluate tax savings with a 1031 exchange. Estimate potential capital gains and depreciation recapture. Calculate capital gain. Subtract the property's adjusted cost basis, which is the original cost minus accumulated depreciation, from the sale price to determine the capital gain. Calculate depreciation. Recapture. Depreciation taken over the life of the property is recaptured at a rate of 25% upon sale. Combine this with capital gains tax for the total tax liability if a 1031 exchange is not used. Compare tax liability with and without a 1031 exchange. Calculate tax without a 1031 exchange. Multiply the capital gain by the applicable capital gains tax rate and depreciation recapture rate to find the total tax liability. Calculate tax savings with a 1031 exchange. By deferring taxes through a 1031 exchange, calculate the full amount that can be reinvested without paying capital gains tax immediately. This reinvestment amount reflects the extra capital retained for the next investment. Evaluate long-term portfolio benefits. Tax-deferred growth. Consider the benefits of compounding by reinvesting full proceeds each time. By rolling gains into new properties, investors can upgrade to higher value assets, grow rental income, and increase asset diversification. Plan for strategic portfolio adjustments. Use 1031 exchanges to shift investments into properties with higher returns, move to markets with greater growth potential, or diversify property types without losing capital to taxes. Understand the potential for tax-free heir transfer. Continual deferral through 1031 exchanges may allow properties to be passed to heirs with a step-up in basis, potentially eliminating capital gains tax altogether upon inheritance. Work with qualified intermediaries and tax advisors. Select a qualified intermediary, as a 1031 exchange requires a qualified intermediary to hold proceeds and handle the transaction. Choose an intermediary experienced in real estate exchanges to ensure compliance. Consult with a tax advisor. Tax advisors can help structure the transaction, verify compliance with 1031 exchange rules, and plan for future exchanges or strategies. Additional tips for using 1031 exchanges. Identify replacement properties early. The 45-day identification period is strict, so begin searching for replacement properties as soon as possible to avoid missing the deadline. Stay aware of exchange deadlines. Both the 45-day identification period and the 180-day completion period are non-negotiable, so work closely with advisors to stay on schedule. Consider replacement property value. To defer all taxes, the replacement property's value should be equal to or greater than the relinquished property, ensuring a smooth exchange without a taxable boot. Summary: 1031 exchanges are a valuable tool for apartment investors seeking to defer capital gains taxes, reinvest proceeds, and strategically grow their portfolios. By understanding the requirements for qualifying, such as like-kind property rules, timeline restrictions, and the need for a qualified intermediary, small apartment investors can leverage 1031 exchanges to expand their investments, diversify holdings, and enhance after-tax returns. With careful planning and guidance from tax professionals, 1031 exchanges facilitate tax-efficient portfolio growth, enabling investors to optimize their financial success in apartment investing.